Afternoon, ladies and gents. It's Simon Brown here doing introduction for today's webinar, which Warren Peacock will be doing. As I said, introducing today Warren Peacock. It's the first webinar he's done for just one lap, but certainly Warren is known. He's got his own site there. You can find it at thetradersplace.co.za. You've maybe seen him. He's been on CNBC a couple of times doing technical analysis and the like. And really, he's bringing a new concept for us. Chatting before we went online, he says he's not here for beginners, really. He's looking at intermediate and advanced in the sense, and that's what he's talking today, Harmonic Trading, taking a different look at trading. And I had this quick squiz at the presentation before we went out, before we started today, and it's something which to me looks intuitive, like it makes sense. And hopefully when we finish this, it'll all make a whole lot more sense. As always, we'll look for 30 minutes, including questions, and we'll take your questions at the end. You're welcome to put them into your question box as it pops up in the GoToWebinar application, and we'll take those at the end. With that, over to Warren.
Thank you, Simon. Good afternoon, everyone. Today, we're going to have a look at harmonic patterns. Yeah, what are harmonic patterns? According to Scott Carney, he states, harmonic trading is a methodology that utilizes the recognition of specific structures that possess distinct and consecutive Fibonacci ratio alignments that quantify and validate harmonic patterns. Now, that comes out of his book called Harmonic Trading Volume 1. In short, harmonic patterns are a set of rule-based patterns that occur in the charts of stock market prices and adhere to Fibonacci numbers. Now, if any of you have tried to use the Fibonacci tools, hopefully this would put a little bit of structure to your analysis. Okay, what we're discussing today, potential reversal zones using the AB equals CD. We're going to find the relevant points in price action. We're going to discover that point B is the important retracement, and the Fibonacci ratios determine which pattern we are dealing with. Now, there are a number of patterns, and today we're going to look at the absolute base pattern, which is the AB equals CD. Important ratios. Now, I know you guys are going to look at this and wonder what all the math is about. You will be able to download this presentation later, most likely by tomorrow afternoon. I'm just going to run through it quickly. The most important one is the 0.618 Fibonacci retracement, and with that comes a projection of 1.618. Now, basically, those are the two that are really important. If any of you are trading the SA40 index, maybe on a 10-minute chart, up to an hour, you are going to be looking at the 0.786 retracement level and the 88.6. On the next slide, you'll see I've put a whole lot of alternate ratios in for you. And then, of course, complementary derived ratios. You can sit down and work all those out. 0.382 you've heard of, 50%, and then there'll be a couple you haven't heard of, 0.707, 1.41, etc. Don't occur that often on the SA index, nor on the shares. Those are really available for guys that are trading maybe the S&P or the Dow. These measurements are based on price extremes. That is the high and low prices or the candle wicks. Now, obviously, if you've been trading for any length of time, you would have realized that candles can work in two ways. You can have a really long wick that can make it way outside of any trading idea, and then you'd rather use the body of the wick, either the open or the close. So, these things, yes, they're rule-based, but they also have to be a little bit flexible. Okay, here we have the bullish AB equals CD, and we can have on the right-hand side there, you can see a little spreadsheet with retracement point C and extension BC. If you have a look, we've got, on the left-hand side, we've got a picture. Those are the two really important levels for the AB equals CD. And like I said earlier, on the SA40, we're looking more at the 78.6, which you can see at the bottom there, 0.786. And on the shares, normally 61.8. So that would be 0.618, and the extension for that would be 1.618. I know this might sound a little complicated if you haven't used fibs before. Those of you that have used fibs, hopefully this will make a bit of sense. And of course, you're welcome to contact me afterwards if you do have any questions over and above what we can cover on the webinar. Important point, bottom left-hand corner. The extension should coincide with the completion of AB, which is the top left-hand A, to B, equals the point C to point D. So let's explain this graph a little bit, the picture. we've got a price move from A to point B. We then have a retracement. And let's just say that point C is a retracement of 38.2% of that initial move. So we get a little bit of impetus, we get a bit of an impulse move, we then get a retracement to point C. The next move from C to D, that last downward section there, should equal the distance from A to B in number of points or rands and cents if you're trading the shares. And that is considered slightly more important by some than the Fibonacci ratios. When we go and have a look at the examples, you'll notice that you can draw it just about anywhere. The whole idea is that this is a potential reversal zone, not a potential reversal price. So it's not a fixed or given thing. It's just an area where you should take note once you've got A, B, C, and D. In other words, in this example, a bullish pattern would mean that we would be looking to buy the stock at point D. We're not trying to trade the C to D level. Obviously that can be pretty difficult. I do know some traders that are trading the index and they are trying to catch that point C to point D. For short term, that's great if you're trading the index with a nice high leverage at 10 and a point or greater. On shares, for instance, I think you're pretty much wasting your time as those moves wouldn't give you any follow through. So bottom line is it is a reversal pattern, a potential ending point, and we would be looking to get into the stock at that point D as a buy area. The first example is an Imperial Holdings. Now obviously I've gone back in history to get some examples that at the time may have been pretty difficult to pick up. One of the things with harmonic trading and this AB equals CD is it takes a lot of practice. Not a little bit of practice, it takes a lot of practice to actually see the moves and ignore the noise on the chart. Now if we have a look at Imperial, I've marked it out quite nicely there. We've got point A, point B, and the only reason we know point B is because we have that retracement level. So you can't number point B. Sometimes the guys get a little aggressive and they start numbering prior points as point B. That is not the case. We have to wait until point C is confirmed, and point B will be confirmed obviously once point C is done. Then we can start drawing in our fib levels. And as I said earlier, we're looking for a potential zone, and we can see that around point C is at 78.6% retracement of that initial downward move. So the market came off on Imperial, it then retraced 78.6% of that value. So from 131 Rand, it pulled all the way back to 102 Rand, and then the market retraced again to 125 Rand. Then we had to wait, and we can see there's probably another A, B, C, D in this area. We had to wait for D to complete. Now, once C is confirmed, so let's just take this little point, it's broken through support over there, and we can now confirm point C is at 78.6. Aggressive traders might consider going short there. Your stop loss is very simple. As soon as the market closes above point C, the pattern is no longer valid. So if you're an aggressive trader, you might have looked at C. I don't recommend that generally. I would prefer to wait for point D. And we can see it went almost exactly 127.8% and failed to hold below the 95 Rand level. We've got those three red candles there with a slightly bullish slant. In other words, it's closing higher on the third candle. And then, of course, we had a gap. Now, you should know about breakaway gaps. That was a confirmation that point D is probably complete. That would be the area we would be looking to get into the stock, wanting to buy it somewhere at 102. If you want a little bit more confirmation, you could wait for the price to actually close above that lower point B at 102.05. Aggressive traders would be trying to pick it up at 127.8 because that is the minimum requirement. If you go back to the ratio slide, that would be the minimum requirement for an AB equals CD pattern. So we go to the next slide, we'll see the result. Okay, so there we have a completed A to B to C, D came down, And then, of course, we've had a big reversal on Imperial Holdings. If you'd gone long down there, you could have waited once again for the close above 10205. If you'd gotten in there, you would have had a pretty decent return up to 120 Rand on this slide. On the next one, I actually took a bigger picture to illustrate it a little bit better. And there we've got Imperial from the lows of 2009, moving through to a high in 2011 to form Area A. It pulls back, retraces to Area D, then goes to C, finally bottoms out on D, and we have that big run up to 164 Rand, and as far as I know, it's still going up. The whole idea, the reason I put such a big picture in, is that there are other harmonic patterns that actually require this flagpole to be valid. The ABCD can be done on its own, and it does not really require a prior trend. Okay, it does not require a prior trend. These can occur in consolidations, and you can trade them on that basis. We're going to now go to the bearish pattern. There we have a bearish pattern. You can see now that these are counterintuitive. In other words, if we look at a bearish AB equals CD, it actually looks like it's trending up. Now there's the old adage in trading, buy low, sell high, and if you are a trader, you're looking to do the opposite as well, and that would be to sell high and buy low. And that is what these patterns give us. The ratios remain the same. Point B is important. Point C's retracement, secondly important. And then, of course, when D tops out, that's when we're looking to make a trade. Now, if you are someone who is not trading with leverage, in other words, you're not trading warrants or you're not trading futures or CFDs, you're trading the physical shares. If you see a pattern like this, the bearish AB equals CD, you may consider selling your holding and waiting for the next bottom. The important point, the extension should coincide with the completion of A to B equaling the same distance, C to D. The extension on this one, we have a pullback to 0.382 or 38.2%, depending which Fibonacci tool you're using. The extension would be to 314, and if you're using 0.886 as a retracement area, the target for that would be 1.13, and once again, the levels are on the right-hand side. Let's go and have a look at a physical example. I used a Veng on this one. It had a pretty decent pattern, and it illustrated a number of points that I was trying to clarify earlier. The first one is, we can see that there's a big wick in the middle of the chart there. I totally ignored that, and the reason was just simply the price closed back within this zone. So therefore, I used the wick on the green candle, which was the first hint that the market might be selling the stock off. We put A at the bottom, B at the top, C in the middle. It pulled all the way through and completed at point D. The dotted lines, these blue dotted lines, are the AB equals CD level. And we can see that the price actually exceeded that, but it went to the next Fibonacci level of 161.8%, and that was of that B to C pullback. Now remember, the first mistake that you're going to make is you're going to try and draw these extensions from A to B. That would not be correct. The extensions are defined by the level B to C. So you draw your Fibonacci from level B to level C, and that extension will give you the potential target for D. The other thing to notice here, this red dotted line is a 61.8% retracement, and therefore we would expect the extension B to C would be 161.8, which is once again at that top over there. Why did we confirm this as a top? Well, quite simply, we've got, firstly, we had the bearish shooting star that also completed a bearish Harami pattern, and then we had these two very negative red candles. You know, once that candle, the last candle in the slide, once that had closed below the Harami, then we would consider the trend to potentially have changed. On the next slide, I've got a slightly bigger picture of it. We can see that this share was trending downwards, and the ABCD would then be a continuation pattern. So yes, it's a reversal of the short-term trend. So from point A to D would be considered an uptrend. If you're using normal trend lines or if you're using moving averages, then this would be considered an upward trend in stock. And one of the risks is we start to buy it once it breaks these resistance levels at around 37.50 cents. Once D is confirmed at that 161.8, those three red candles being very bearish, and then we have a breakaway gap on the downside, very risky to now be buying that stock. Then we throw in the ABCD pattern, and we're looking for a continuation of that prior trend. Now, anyone who's traded stocks on leverage will know it is virtually impossible to get a full extension on a short. In other words, the market, if a share is already gone from 45 Rand to 31 Rand, it's highly unlikely in normal trading without any fundamental issues for that stock to go to 10 Rand. It's unlikely and unusual unless there are other circumstances. So the longs tend to work out much better than the shorts. That means if I'm going to go short, I would have a smaller target area. I wouldn't be looking for a full extension of that entire ABCD pattern like we had on Imperial. The next slide will illustrate a little bit better what I'm speaking about. And there we have the completion. The stock fell off from that 39.50 Rand mark and pulled all the way back and gave us a double bottom at 31.70. Perfect place to exit your position. So if you were short at D, you would have exited down at level A. You've got a double bottom. Your normal technical analysis can come back into play. The ABCD is considered completed. And when we last looked at Veng, we can see it was actually breaking through that 178 level. ABCD is no longer valid once this bottom is confirmed, firstly. And secondly, once D is broken, those people that are maybe looking to add to their winning trades could look to add to the position here. And then, of course, the important thing is stop losses. As I said earlier, if you short the stock over here at point D, the stop loss is simply a close above D on the initial move. And then however you trail your stops downwards, obviously you can do the same thing. But once it confirmed the double bottom at that A level, then I would have considered this trade complete. Now yesterday we had a nice intraday pattern, and it was quite fortuitous. These patterns do occur on all time frames. All time frames, from a weekly chart right down to a tick chart. And what we have here is the SA40 on a 10-minute basis. Yesterday we had that big run-up, and we had this consolidation through the afternoon. The usual up till 4 o'clock has become quite common. That 4 o'clock is when the moves start to happen. And we've got an ABCD pattern. The C level pulled back to 78.6. So once again, you can use the reference of the earlier slide with all those ratios. It pulled back to 78.6. The target should be 127 to confirm point D. And we can see that we had two candles at that level. Neither one of them closed above that point D, and that would be considered bearish. And we can see what the result was all the way through to 7 o'clock last night. The question now, of course, is where do you enter? The closer you can get to your stop loss, the better your risk-reward ratio. Entering on that doji over there, maybe not such a great idea. Dojis are indecisive areas. The price could have done anything after that. Aggressive traders would have entered at 127.8 of that first red candle. As the price pulled up there, nervous traders obviously would have been expecting a continuation of the uptrend. And we can see confirmation really only came once that level C was broken. We had 1, 2, 3, 4 10-minute candles. We had the spinning top. We had a shooting star. We had a break of support confirmed. You could have easily shorted. Those of you that are looking for more confirmation and are trading the index, we could have shorted on that red candle below point A and point C. In conclusion, AB equals CD is an ending pattern. Sorry for the spelling error there. It is an ending pattern. In other words, you're looking to go in the opposite direction to the trend. Be aware that picking bottoms can be really dangerous, so make sure your stop losses are in place. The pattern is only confirmed once point D has bounced. The ratios are important guidelines as to which pattern we are dealing with. As I said earlier, there are a number of these patterns. The fact that AB equals CD is slightly less important than the ratios. I like to use the ratios. I find them a little bit more structured than the actual, that the two price moves must equal each other. Quite often you do get AB equaling CD, and sometimes when you don't get it, the ratios work out much better. You obviously would want to try it out, maybe do a couple of paper trades, go and have a look at history, work out which one suits you. If you are someone that's been using Fibonacci for some time, you would most likely prefer the ratios like I do. If you are someone that is trading the standard Western technical analysis, you might be looking for the actual AB to equal CD. These patterns are only tradable once they have completed. I cannot emphasize that too much. There are 6 harmonic patterns in total, and the ABCD is the basis for all of them. The difference would be is the others require a pole, they require some sort of underlying trend, as they are considered continuation patterns, and you would be buying against the short-term trend. I trust that you found this information an helpful addition to your trading arsenal, and thank you for listening to me. Any questions?
Thanks, Warren. As I said, it truly makes sense to me, although I think I'm going to want to watch that video again. Folks, if you've got questions, certainly put them into the question box in the GoToWebinar app. We'll throw them out there. Warren, a couple come already. Someone's asking what's SA40. Warren's trading with IG. Otherwise, people will know it as Aussie 40, which is our futures market. 2 questions. Colin is asking about, is there a book? And Susan says, is this end of day or intraday?
Okay, the first question, is there a book? Yes, there is. Harmonic Trading Volume 1 and Volume 2, as quoted at the beginning of the presentation. I can't remember his name offhand. You're welcome to go and have a look online for that. So the
intraday or end of day or both?
It works on all time frames. So you can look at it end of day if you're someone that is investing in physical stocks, or maybe you're trading with leverage over longer periods of time. You can certainly use it on all time frames, so end of day or intraday.
Simpiwe is asking about the other 5 harmonic patterns. Simpiwe, we will get to those. We didn't want to completely overwhelm and take hours of time today. I'm sure that we'll set up more. This, as I said, was the first coming through from Warren. So first point, we'll get to other patterns and more TA stuff. Nil, if you've got a question, folks, questions, put them in the text box. We can't take audio questions today because my headphone setup isn't quite spot on. So if you've got any more questions, put them in the text box. A question coming through again from Colin. I think what he's trying to say is okay, so we're looking at stocks there, looked at indices as well. There were future indices. We've said it works intraday, end of day. It works across products. In other words, and he says particularly potentially FX or something.
Yes, it works across all markets as well. It's the Fibonacci ratios are inherent in life in general. You can look around you and you'll find those ratios everywhere, and therefore they cross markets. I've used it in FX. It works reasonably well. I don't trade FX anymore due to time constraints, but yes, it does work there.
And another question from Simpiwe, he's asking around the sense. Oh, sorry, it disappeared. I'll get it back in a moment. Anil's question. If one went long at D, what's target exit? Should one close partial at A?
I look for the completion at A. In other words, I'd look to exit my position at that double top or double bottom area. Once again, it depends what you're doing. Because I trade on leverage, I'm not looking for the entire move. I'm just looking to make my targets.
Lamek Nabutsi is saying are the ratios same for bullish and bearish patterns?
Yes, they are the same.
Folks, keep the questions coming. I just got to quickly find Collins again, which I managed to inadvertently delete. Ah, there's it is. Okay, brilliant. It's a great question too. I don't know what deleted it by error. He's asking, he says Elliott Wave. He's looked at Elliott Wave. He's tried to use it. In fact, he mentioned some of the EWI stuff, Elliott Wave International. Yeah. He says, have you sort of gone through Elliott Wave and settled on Harmonics? And if I can add to the question, what I think he's trying to say is, in essence, have you decided that perhaps Harmonics is a better or simpler or more efficient than Elliott Wave?
I think the only thing that you can really find is simpler. There's no one thing is no better than any other thing. I just found that the ABCD had simpler rules, straightforward structures. Elliott Wave talks about the 5-step, 3-step, 5 up, 3 down in an impulse, and then of course 5 down and 3 up in a corrective market. It becomes very complicated when trying to tie up all the Elliott Wave possibilities. When you start getting complex consolidations, X, Y, Zs and all those things, zigzags, it gets very, very, very complicated. I found this a lot simpler.
Yeah, and that's a good answer. Simpler rather than better. I would never put my head on the block and say better, but certainly I think lots are simpler. Johan is asking which platform you are using to trade.
I use the IG Markets platform.
Yeah, that's what I figured. Folks, any more questions? I'm not seeing any more coming through. As I said, as Warren said, this webinar will be up. It will be online by lunchtime tomorrow. The system will send you an email with links and the like, but if you just go to justonelap.com, you'll obviously find it there as well. And we will be bringing Warren back for more of these to expand Harmonics, but also just the plan is to get a real trader in the hot seat and help sort of get some of their knowledge out of their heads into our heads to help us being traders. I'm not seeing any more questions coming through. We'll leave it there. Warren, thanks very much. Really appreciate it.
Thank you, Simon.